Trust me, I get it. You're a first-time home buyer, you're looking to buy a home soon, and you keep hearing all kinds of different types of loan programs or different types of scenarios that you should be considering. Should you consider an FHA loan? Should you be in a conventional loan? No, wait, if you're a veteran, you should have a VA loan. But have you considered a USDA loan? Maybe that's the best option for you. So all kinds of options, all kinds of terms, all kinds of new things to learn. It's very confusing. So I'm going to cut through all the chaos here, hopefully, and I'm going to dig into what is the best loan for you as a first-time home buyer. Spoiler alert, even the best loan for you might have its disadvantages. Let's explore all this, and as I like to say, let's kick off this rodeo right now. Hi folks, I'm Kevin Fagan on the Mortgage Patriot on your side, nestled here in the hill country above San Antonio, Texas, serving all you great patriots of Texas and all you great folks all around the country. So another great one today. But before we get to that content, if you would hit the like and subscribe below, it really helps me bring up the YouTube algorithms to your benefit, shows you my my collection of videos that I put together over the last year and a half or so, and bringing you just great content. So again, like and subscribe, and let's get into that content right now. So this video is all about what is the best loan program for you as a first-time home buyer. As we get into that, we have to define what does best really mean. It's not necessarily the program that gives you the lowest interest rate, for example. Even though you have the lowest interest rate, that doesn't mean you have the lowest monthly payment. So we're going to define what is the best by three different criteria. Number one, which loan program gives you the lowest monthly mortgage payment? Okay. Number two, which loan program provides the least amount of cash that you have to come out of pocket for and write a check for at closing? And lastly, number three, how much home can you buy with a certain loan program? Because they're all going to be slightly different, believe it or not. So as a first-time home buyer, you really only have four choices in terms of loan programs. The first one being the conventional loan, the second one being the FHA loan, probably the most common. The third loan program is the USDA loan, a little less common, but it is available to you. We'll go over that. And lastly, number four, the veterans loan, the VA loan. All these loans have different criteria or guidelines with respect to things like credit scores or debt to income ratios or insurance premium rates. So all those guidelines impact those three things we talked about of how low will your monthly payment be, what would be your cash to close approximately in this loan program, and how much home can you buy with this loan program. We're going to show you some examples here, and hopefully this will all make sense to you. So in my examples that I'm going to show you for what is going to be the best program for you, we have to use assumptions, right? Let's focus on a hypothetical household income of about $85,000, be it combined with spouses or just alone. So $85,000 household income example. We're going to walk through which out of these four loans, what that looks like across the board. Let's stack now these four loan programs side by side and see what works best given their unique nature of each. And we're going to look at four aspects of each loan program. And firstly is the credit score allowed. Secondly is the amount of debt to income you can have. And thirdly is the insurance premium, the monthly insurance premium. And fourthly is the seller concession, how much seller concessions are allowed in this program. So let's go across the board with credit scores. For a conventional loan, credit scores need to be at least 620 or better. For FHA loan, 580 or better. For USDA loans, 620 or better. And with a VA loan, typically about 600 scores or better. With respect to debt to income, now this is the total debt monthly, which include your housing payments and your debts, your credit cards and so forth. All that combined in a conventional loan can be no more than 50% of your monthly income. For an FHA loan, it can be as high as 56% of your monthly income. For a USDA loan, that's cut all the way back to 41% of your monthly income. And lastly, VA is the most expanded one at 60% roughly of your monthly income. With respect to monthly mortgage insurance, anytime you come out with less than 20% down, most lenders will charge what they call monthly mortgage insurance in case you go into default. They want to be covered. So what is that fee? On a conventional loan, assuming your FICO scores are about 680, that's going to be about 0.80% of 1%. The FHA factor will be 0.55 of 1%. The USDA loan is going to be about 0.35%. And VA loan don't charge any monthly insurance premiums at all. One of the great benefits. Lastly, what are the maximum seller concessions allowed for these programs? In a conventional loan, you're allowed up to 3% seller concessions. With an FHA, you're allowed up to 6%. With the USDA loan, you're allowed up to 6% as well. And a VA, you're allowed 4%. Now we're going to go through an example and explain what all this has to do with how do you determine what's the best outcome for you. So let's start answering which is the best loan program. For the question of how much home can you afford or how much can you qualify for given these different loan packages, let's go back to that $85,000 household. In an $85,000 per year household income under a conventional loan, assuming about $900 of excess debt in the form of, say, car notes and credit cards and so forth outside of your housing, you can afford about $290,000 home. In the FHA world, you can apply for and qualify for about $300,000 worth of house. In the USDA world, you're only allowed about $225,000 of home. Why is that? Well, because the debt to income ratio is so small relative to FHA and conventional. In other words, they don't allow you to have but only 41% of all your expenses, including housing, to be expressed in your monthly income. So that allows for a lot less home. And lastly, a VA, where does that stand? Well, you can buy about $330,000 worth of home in a VA loan. So of course, you have to be a veteran to get the VA loan. But if you are a veteran, you definitely are going to want the VA loan because you can, in terms of how much house you can buy far more than a USDA, FHA, or conventional loan. A quick note about some of these loan programs. As I mentioned, with of course, a VA loan, you have to be a veteran or an active service member of the military, or otherwise this loan is not available to you. And with USDA loans, those are only allowed in certain geographic regions, typically those that are outside of city limits. Now, it doesn't have to be way out in the boonies, but it can be typically on the outskirts of metropolitan areas, still qualify. If you're wondering, if you send me your address or put it in your comments where you're looking to buy, and I can find out if that's available for a USDA loan. Now remember, of course, like we've talked about, you can only afford a far less amount in USDA loan because they're highly restrictive in terms of your debt to income. So you can't buy as much home as you would be able to in an FHA loan or conventional or VA. Let's tackle now the question of which loan would provide the lowest monthly payment. And the lowest monthly payment in our example, we're talking about everything. We're talking about principal and interest, property taxes, property insurance, HOA dues, and monthly mortgage insurance premium, all 5 of those factors. Okay, that payment is going to be the highest in a conventional loan. Why? Because you're going to have an interest rate which is higher than all the other 3 options combined. The FHA, the VA, and the USDA are going to be roughly 3/8 to a half a point lower than the conventional loan. And said all that, on a $300,000 home, your payment monthly, including everything, is going to be about $2,850 with today's rates. The next in line would be FHA, which comes in about $2,680 per month. Then followed in second place by the USDA loan, which would be about $2,650. And lastly, the most and least expensive on a monthly basis and the best option would be a VA loan, coming in at about $2,600 per month. Let's address that last question of which loan program will allow you to write the smallest check at closing. Because, hey, it's just human nature. We all want to write a very small check whenever we buy anything, right? Much less a home. So let's tackle the first two. For a VA and a USDA loan, those are zero down loans, but you still have closing costs and escrows to pay for. How much are those? On a hypothetical $300,000 purchase, at least in the state of Texas, you're talking about $9,000. But remember, you have seller concessions that are allowed for you. Some of that needs to go to your agent, but outside of your agent, we can still bring some of those concessions to closing and knock down that $9,000 figure on both those loan programs to very low, sometimes less than $3,000, sometimes zero. But let's call it $3,000 or less in a VA or USDA loan. Not bad at all. But again, remember on USDA loan, you can't afford much because they restrict you in terms of how much debt you can have. And of course, on the VA side, you have to be a veteran. So 90% of the outcomes are going to be either a conventional loan or an FHA loan. We'll tackle that right now. So the cash to close regarding conventional loans and FHA loans varies greatly. Why is that? It's because for a couple of reasons. Most down payment assistance programs are tied to FHA loans. Some of them can be applied to conventional, but 80% of the time, I'd say at least, FHA loans are the only ones that allow for down payment assistance programs. Also, as we talked about earlier, the seller concession is twice as high on an FHA loan. It's 6% versus 3% for a conventional loan. So what does this all mean? If you buy a hypothetical $300,000 house, at least again in the state of Texas, your state will vary. We can talk about it. But in the state of Texas, $300,000 house, you're going to write a check somewhere in the neighborhood without any help before any down payment assistance or seller concessions of about $19,000 for an FHA loan and about $24,000 for a conventional loan. But now let's talk about the help you can get. With the down payment assistance and seller concessions, you can bring that FHA number of $19,000 down to probably below $10,000, sometimes even closer to $5,000. So I've got strategies to be able to do that. You're going to want to hear those. So again, on an FHA loan, your normal check would be about $19,000, but with down payment assistance and seller concession combined, we can get that well under 10 in many cases and closer, sometimes even below 5. In a conventional loan, it's much harder to do because again, you don't have down payment assistance attached to it for the most part, and concessions are only 3%. So you're coming out of pocket without any help for about $24,000, as I mentioned. I can probably get you down to the mid-teens sometimes with using other strategies. So that's the big difference with the FHA loan versus the conventional. So let me summarize all this right now. So which loan is best for you? It's going to depend on your circumstances. If you're active military or a veteran, absolutely the VA loan is by hands down the way to go. Beats everything across the board in every way. Lowest payment, lowest down payment, and so forth. If you are outside of the urban areas, in a rural area, the USDA loan might be the best way to go if it allows you to qualify for enough house, because like we said, it's pretty restrictive. But if you're able to qualify for it, then yes, your monthly payment will be lower and your cash to close will be lower than an FHA loan, for example, or conventional. So now we're down to FHA or conventional. If you plan to own your home for less than 5 years after you buy it, FHA loan is probably the best way to go. Why is that? Well, because in a conventional loan, your monthly insurance premium drops off once you obtain 20% equity in your property. Or I'll say that again. Once you obtain 20% equity in your property, your loan balance, the difference between your loan balance and your equity has 20% equity, you get to drop your mortgage insurance premium. On a conventional loan, that could be $200 a month. So that's a big deal. But on an FHA, it does not go away ever, your monthly insurance premium. So if you're going to stay in your home for about 5 years or less, go with the FHA, because that mortgage insurance premium is not going to fall off, and you're entering with a lower payment because you have a lower interest rate. So FHA is the way to go inside of 5 years. Conventional loan would be the way to go outside of 5 years. So it all depends, of course, on your circumstances for all 4 of these loan choices. It is very confusing. I hope I gave you some clarity on this. Let's talk about it. You can call me at my number here, 210-317-6514, or you can schedule an appointment with me and let's talk. So Kevin Fagan, Mortgage Patriot, on your side. Make it a great one.